Hello, everybody. So we're going to get started. First of all, thank you all for coming, both those of you who are here in person and those of you who are online. We have a fair number of people online. I always find it interesting that the students kind of sit towards the back. They should feel comfortable moving forward, but I won't make you move forward, but you should feel comfortable in future seminars moving forward. I'm John Haig. I am the co-director of the Mosavar Rahmani Center for Business and Government, and I co-direct with Larry Summers. We are very, very fortunate today. The title is The Future of Central Banking, and our speaker is Jean-Pierre Landau. He is an associate professor of economics at Sciences Po in Paris, and a former senior official at the French Treasury and Central Bank. In particular, he served as the deputy governor of the Bank of France, executive director for France at the IMF, the World Bank, and the European Bank for Reconstruction and Development. He was also undersecretary at the Minister of Finance in Paris, and he's been a member of the board in his different capacities, member of the board of the Bank of International Settlements in Basel, a G7 and G20 deputy, and a member of the Financial Stability Board and its steering committee. And he's written a book, co-authored The Euro and the Battle of Ideas with Marcus Brunemeyer and Harold James, published by Princeton University Press. Multiple papers. I think some of his more recent work is around digital assets, cryptocurrencies. We had a good discussion yesterday in a student study group, a fantastic discussion with Tim Massad, who had been the former chairman of the Commodities Futures Trading Commission here in the US. And he was a senior fellow here from 2018 to 2020 and is currently a research fellow at the center. So we're very fortunate to have him here. The floor is all yours, Jean-Pierre.
Thank you, John. It's a great privilege to be here, and it's a privilege to have you introduce this seminar. I know you don't do that very often, so I am very grateful for this distinction and for your attention. So we're going to talk about central banking in a way which may be a little bit disorganized, but I'm going to try and identify with you some of the challenges, some of them very common, some of them very new, that central banks are facing in terms of the situation they are confronted with. And I'd like to start with a very interesting episode, very recent, about what happened in the UK, because we had a sequence of events in the UK which spanned over a matter of few weeks, 3-4 weeks, which was extremely interesting, extremely enlightening, extremely instructive, and which is a real-time experiment in economic and monetary policy, which teaches us a lot of things about the challenges that central banks are facing. And it's not often in real time, in real life, that you have such an experiment on a such short period of time. It was extremely instructive. And let me say that I think at the end of the day, the Bank of England performed very well. It was not something which was a given when they started, but they performed very well during this episode. So just to remind you over a period of a few weeks what happened, right? So on September 22, the Bank of England announced in the course of their tightening monetary policy cycle that they would reduce their portfolio of government bonds, which they had purchased over the last 5 years in the quantitative easing framework, and that they would reduce it by an amount of 80 billion pounds over the next 12 months. So they would selling bonds, they would let bonds mature, but they would also sell bonds. So on September 22, the Bank of England said, we are going to sell government bonds on the market. Sell them, right? Then on September 24, there's a new government in the UK. The new government makes a budget statement, and that budget statement announces an enormous amount of tax cut and an increase in the financing gap of the government by around 2% of GDP. And the markets react very, very negatively to that. And in a matter of hours and days, you have the interest rates, the long-term interest rate going up, and the exchange rate of the pound depreciating. So when you have those two phenomena together, it's a clear sign that you have a confidence problem in the economic policy and in the government. Then on September 28, so that's exactly about 1 week after they announced that they would sell bonds, the Bank of England announced that they would purchase bonds. And they would purchase 65 billion at the maximum over a period of 14 days, right? So they reversed themselves. They could be seen as reversing themselves dramatically in a matter of 1 week for huge amounts, right? So that was something which, in my view, was totally unprecedented. And people had to be worried about what happened. And of course, on the face of it, if you stop the schedule here, you got that feeling that the Bank of England was going to actually accommodate by monetizing the increased financing gap of the government, and that they were under the spell of what we call, in a theoretical term, fiscal dominance, meaning there would be pressure to monetize the government debt. They were very much aware that this misperception could occur. They made very strong statements that they would continue toughening monetary policy. They made clear that the decision process was involving the Financial Policy Committee, not the Monetary Policy Committee. And they wrote a very long letter to the chairman of the Treasury Select Committee of the House of Commons to explain why they were doing it and what they were doing it, right? But still, there was a contradiction. And they sent all these signals. And then the delay was supposed to expire on October 14th. Right? We're talking about very recent events. And on October 12th, the governor of the Bank of England was a very dramatic episode, right? On October 12th, the governor of the Bank of England, he was in Washington, D.C. for the annual meeting of the IMF and the World Bank, and he made a statement. So it was a Wednesday, and he made a statement Friday. We said Friday we would stop buying bonds, and Friday we stopped buying bonds. And those people who have position to unwind and cover precaution to make, they have 3 days. After that, it's finished. Right? And it came. I have too much, no?
Can we switch this?
Sure. Good. Thank you. Sorry about that. And so they had 3 days to face. And at the time, if you read the financial press, it's only 3 weeks old. If you read the financial press, people were thinking that they would not abide by the deadline, that they would not respect their own schedule, that the markets were too disrupted for the Bank of England to stop their intervention, right? And there were rumors, you know, that governor, he burned his credibility by a too rigid statement. He burned his bridges. He doesn't know what he's doing. He's coming from the supervisory side of the bank, so he does not very well understand the market. So you are everybody thinking that he had made a huge mistake, right? And then on the Friday, they stopped buying bonds. And then 2 days after that, of course, the government changed. And the government reversed their fiscal policy totally and dramatically, right? And yesterday, they're starting selling bonds again. So that was an extraordinary episode, which I think deserves to be studied in detail for people who are interested in central banking, because at the end of the day, the central bank got what it wanted. It calmed down markets. It did not change in monetary policy. And to the extent that there was an incompatibility between fiscal and monetary policy, fiscal policy changed, not monetary policy. So that was an extraordinary episode, in my view, of big success in terms of a central bank keeping its monetary power and the success of monetary dominance. Nevertheless, it was a very delicate episode. And part of my talk today will be about those episodes coming to haunt us in the future and how they will be dealt with, because that is the situation we're in. So it tells us basically 3 things. The first thing it tells us, and that is, in my view, something which is every central banker is aware of, but we don't talk much about it. They have one instrument, which is asset purchases, right? And that same instrument can be used into two different directions. It can be used to do monetary policy, or it can be used to ensure financial stability on the markets. And up to now, those two objectives pulled in the same direction. Right? In March 2020, an episode on which we will come back again, the Federal Reserve spent about 1.5 trillion to stabilize the treasury markets. But there was a moment where they needed to do monetary stimulus at the same time. So the same tool was serving two objectives, but those two objectives were going in the same direction. But now we are entering a period where the two objectives may pull in opposite directions. You may want to tighten monetary policy on the one hand, but you want to ensure some kind of stability on the debt and financial market on the other. And on one hand, you want to sell bonds, and on the other hand, you want to buy bonds. And you have only one instrument, which is asset purchases, trying to navigate between those two objectives. I think this is one major problem that the central bank are facing. I will give you my own sort of opinion on how to do it, but the Bank of England did it brilliantly, but you cannot assume that this kind of performance will be repeated in the future. Second point, markets are extremely unstable, including, and this is a kind of new phenomenon over the last 2 years, very liquid market in advanced economy sovereign debt are unstable. The US Treasury market froze in March 2020, and all other sovereign debt markets froze in 2020. That is something that people would not have imagined. This is a new parameter to take into the picture, and I will say a few words about it. And finally, of course, we are a period of a high debt, a high percentage of that debt which is held in the central bank balance sheet, and that creates the prospect of the famous fiscal dominance and the possibility that the fiscal authority and the monetary authority are playing the game of chicken. This is a formula which got from a famous Sergeant Wallace article on unpleasant monetary arithmetic in the 1970s, and this is with us. And it is very important, and I will mention it in a minute, that even the perception, the big lesson of that article, which goes back 50 years ago, is that even the perception that the central bank might yield to fiscal dominance is enough to disanchor inflation expectations and to bring inflation right now. So that is the problem, right? 1, 2, market instability, and you don't want to yield to fiscal pressure. So I will briefly run through points of how to fight inflation in the current circumstances. This is very, in my view, commonplace, but being very old, I realize that a lot of people in the commentary today do not have the theory of inflation very good anchored in their minds. So I will say a few words about it. What does it mean for the central bank for being market makers of last resort, and how do they deal with the possibility of fiscal dominance? So this is a triangle: price stability, financial stability, fiscal stability. And we see that on each side of the triangle, they are facing some kind of difficulties, right? There may be a conflict between price stability and fiscal stability, and this is a question of fiscal dominance. You don't want to be seen as monetizing public debt, especially when public debt is very high. And this was a situation where the Bank of England risked to be when they were rebuying bonds, and they were made very clear in their communication that it was not their intention. Fiscal stability, the high level of debt, the uncertainty on the policy of the politics of debt, maybe in this country and so on, that may trigger bouts of financial instability, even on very, very liquid sovereign debt market. And we'll say a few words about what happened in March 2020. And we have new forms of financial intermediation. We'll talk about it, and that forces the central bank to play an increasing role in terms of market makers of last resort if there is financial instability. So you have a potential of very vicious circle, which the Central Bank of England managed to avoid, which is you want to ensure market stability. To ensure market stability, you have to intervene on government debt market, and if you have to intervene on government debt market, you may be falling to the perception that you're monetising government debt. Of course, this is a circle that the UK has been facing. This is a circle we might face in the euro area if some peripheral debt becomes destabilized. And this is a circle that everybody may be facing in the future if you take a long-term perspective. So it is going to be a very difficult balancing act. And my own thesis, which I will develop to you right now, is that this is sort of the easy part if there were not this. Okay. The central bank have the tool to fight inflation, even in the current circumstances. They can do it, and they can do it, in my view, in the current circumstances, without creating too much damage in the economy. I think it's still possible right now, at the moment we speak, to avoid a very damaging recession. They may have a slight, moderate recession over the next semester if financial stability and fiscal stability are preserved. If the financial tightening, the tightening, monetary tightening creates financial instability, then I think all bets are off, and there is a danger that it might happen. So this is my diagnosis of the current situation. So fighting inflation, let's go back to the textbooks and the basics, which a lot of commentators seems to have forgotten, right? It's very difficult in the difficult circumstances because this is the worst possible environment that the central bank is facing, which is a negative supply shock. Negative supply shock, meaning the supply gets restricted, the price go up, and you have to fight it one way or another. And the only way you can fight it, I will come back to it, is by lowering demand. And a lot of people don't understand why you have to restrict demand when the problems come from the supply. And that is something which has to be explained. I'll say a few words about it. But you may have read some commentators like Martin Sandbu in the Financial Times, who made an echo to this thesis. He quotes a series of tweets by some European prime minister, the Finnish prime minister, which I don't understand. Why do we have to restrict demand? Because oil prices go up. This does not make sense. So we're going to try and explain that. We can avoid, as I said, deep negative consequences. We still are in a situation where long-term expectation inflations are stable. And that's what makes me optimistic about the possibility to get back to low inflation without creating too much material damage to the economy. And we have to preserve financial stability. So this is, this is a graph which shows different kind of path for the price level. And I'm not going to comment on each path, but it's very interesting because in the public comments, people confuse the shock on price, inflation, deflation. What is important is that we have shocks. And our understanding of inflation, I'm not going to write any kind of models or whatever, our understanding of inflation is that it's not a shock, it's a process, right? And the problem for the central banks is what transforms the shock into a process. So I have oil prices going up, that's a shock, that's this, right? What transforms it into higher inflation for the long run and a dynamic of increasing prices. And of course, the way the central banks put it is through expectations. The shocks is transformed into a process if people start thinking that there will be inflation in the future and acting accordingly in their wage and price formation process. So the central banks think they cannot do anything about the shock, but they can influence the process. And that's all they're trying to do. It's not in the power of central banks to prevent oil prices to go up. It is in the power of central banks to try and prevent a shock in oil prices or semiconductor prices or whatever bottleneck is in the current post-COVID environment to prevent it to materialize into a process for expectation. And that's what they're trying to do. So this is the worst, okay? And you can see these are the long-term expectation, both in the euro area, inflation expectation, and the United States. And you see, this is the famous 5 years in 5 years swap, right? So it tells you the inflation that financial market expect from 2027 to 2032, right? Long term, 5 years in 5 years. And you see that the problem we had in the previous period is that they were very, very low as compared to the objective of price stability of 2%. And now they've gone up. So in a sense, and the central bank would put it, the deflationary spirit has vanished, but they are not extraordinarily high as compared to the objective, which is 2%. They are about at the objective, right? You don't want that to go any further. That's why you react very decisively. because if you go up any further, then you may have big problems bringing them back. It took a long time to try and bring them up, and you may have very big problems. These are very inertial expectations, and so you have to be very careful. And so with this framework, you can understand how some criticisms are misguided and some questions are real, right? The misguided criticism that you hear everywhere is that interest rates are not the right tool to fight a supply-driven inflation. Okay. Again, why do you raise interest rates if the cause is oil prices, right? And the answer to that is twofold. It's an imperfect answer, but it's the only one that you can give, right? First, I cannot stay idle. If a central bank stays idle when you are 8 or 10% inflation, there you're signaling that you don't mind, and you're signaling that you don't mind, then you accept that the process and the cumulative process of inflation expectation is going to develop. So you have to do something. And you have only one tool, which is interest rates. This is the only thing you can do. So it's a very imperfect tool. Everybody will admit it, to fight negative supply side shocks. But this is the only thing you can do, right? So the criticism is misguided in this regard, because you have to act. You have to act in a convincing way. And you have to act in a way which would signal people that you are not going to accept that the inflation process will develop, inflation expectation. By the way, if you look at the level of current interest rates, as compared to current inflation, they are still in real terms very low. If you have interest rates of 4% with an inflation of 8%, in an instant, it's a real interest rate of -4. It's not that much of a restrictive policy. Obviously, if you think that inflation is going to go back in, let's say, 12, 18 months to 2%, then you have a higher real interest rate. So this idea that you should do nothing because it's a supply shock is a lethal idea, and we have history to show it. I'm old enough to have been through the 70s, and I can tell you, staying idle when you have inflation going to that level is a recipe for big problems. And the recession, which was necessary at the beginning of the 80s to solve that problem, was enormous. So that criticism is misguided. There is a second question, which is more tactical, but which is very interesting, which is, should they stop now? Now they have risen the interest rates to significant level. What is the problem? And it has been put, in my view, in a very nice term in a recent set of tweets by Olivier Blanchard, the former head of the IMF research department. And he said, you know, you have two problems. Of course, what you do now is going to have an effect in 12 to 18 months. That's the lag problem of monetary policy, very well known. Okay, so maybe if you react now, if the economy has already stabilized or is in a downward path in 18 months, you may overreact now. So that's the lag problem. But on the other hand, if you do nothing while instant inflation is at 8 to 10%, then you run the risk of seeing as allowing expectations to develop. And so there's no perfect solution to that problem. There's no perfect solution to that problem. And he ends up like that. And I think there's a good tactical debate on that. For me, I've never been personally more on the dovish side in terms of monetary policy. But for me, I think the case for acting very strongly now is very, very strong, because you don't want to run the risk that inflation expectations are definitely unanchored. And I think also, I'll come back to it in a minute, I think acting now may stabilize the financial markets more than having a progressive way. Because what destabilizes the financial markets may be the expectation of future uncertain path rates. So the sooner, in my view, the central bank gets to the level which they seem appropriate as the peak of interest rates, the better they are. But that's a personal view from someone who just now reading the newspapers and having no access to any kind of market or economic deep information. But that's a tactical choice. So wrong criticism, good question. Let's go back to the second point, which is the challenge to financial stability. And that's, in my view, the most difficult and interesting part of the current situation. You have some kind of very old situation where interest rates are very low for very long. People tend to build leverage. They tend to build fragile financial structure. They extend maturity transformation in a very unsafe way. And then when interest rate increases, they cannot manage their exposure, they cannot manage their exposition, they cannot manage their situation. And then you have this kind of financial shocks, which is triggered by monetary policy normalization. This is very old, and it happens at each monetary financial cycle. And this is basically the rationale for what we call macroprudential supervision, to have a policy of risk management by the financial sector, which is tightened when interest rates policy are low. I'm not sure it happened in the last cycle, but it should have happened. The big problem, I think, and this is a big problem, and you see that problem emerging. And if I have a major concern personally for the next 15 months, it's there. You have structural change in financial intermediation, in financial market, which will make it very, very difficult for central banks to manage the situation. And you have a new fragility on government debt market, which still needs to be explained and explored, but it's still, in my view, a sort of very worrisome concern. So let's spend a few minutes on looking at those two factors. First one, structural change in financial intermediation. Up to 10 years ago, most of the maturity transformation, at least 60% of the maturity transformation, and in the euro area, 85% of the maturity transformation on the financial sector was done by banks, right? And banks were fragile, they were a source of systemic risk, but at least you know where they are. You have a bank, you have its balance sheet, you can analyze balance sheet, you can analyze position, and it needs the central bank. The bank has an account at the central bank, it's connected to the central bank, so you can regulate it and you can support it if needed when there's a liquidity crisis. Lender of last resort function, right? That's a clear. Now with Basel III, the banks have been strictly regulated, which is a very good thing. You don't hear any problems about banks right now, and I don't expect there's going to be problems with banks right now with the monetary tightening. They've been very strong balance sheet in terms of capital, in terms of liquidity, but financial intermediation has migrated elsewhere. Okay. And because it has migrated elsewhere, it has migrated into the so-called non-bank sector, which is a sort of set of financial institutions, money market funds, commercial paper market, insurance company, pension funds, and so on, which have overtaken a new role in maturity transformation. And especially worrisome, and the IMF has made a chapter in its latest financial stability outlook, global financial stability report on open funds. So open funds are funds which issue to you liability which are immediately redeemable. You can ask for your money back in less than 24 hours, but a lot is invested into very, very illiquid assets, and sometimes more and more unstructured products. And people who've gone through the previous crisis, it rings a bell, you know? And these funds are a source of immense fragility in the financial system, immense fragility. And it's been known for 2, 3, 4 years. 3 years ago, the then governor of the British Central Bank, Mark Carney, in a testimony to the House Select Committee, Treasury Select Committee of the House of Commons, said, those open funds are based on a lie. The lie is that you can redeem your money at sight, whereas the assets are invested into very, very illiquid security. Now, when a major central bank tells you something is a lie, you would expect a reaction, and there hasn't been any reaction. Right? And there are reasons for that. I mean, the structure of regulation on non-banks is very different from the structure of regulation of banks. The market regulators don't have, in my view, what we call a macroprudential perspective. They're happy if each and every fund has enough safeguard measures to protect them, but they don't see that a problem in a fund may trigger enormous problems in other funds. So that's a big question. That's a big question. And those funds do not have access to the central bank balance sheet. They do not have accounts with the central bank. And so when there's a shock coming, the central bank has no alternative but to step in and buy whatever assets they could buy so that the liquidity is restored to those institutions, to those markets. And that put an enormous pressure to the central bank balance sheet management, which, in my view, they cannot avoid. Right? So it may be too late right now, but the first item on the agenda in financial stability would be to come to some kind of prudential regulation of open funds and non-bank financial intermediaries. If there's a shock in the 6-9 months, my feeling is that it will come there, and I'm sure that the central banks are prepared for it. But that, of course, may force them into the kind of situation that the Bank of England was forced to have to provide liquidity and expand their balance sheet at the moment they are tightening monetary policy. So this is a dilemma which is not exceptional, which may come back, and may be a permanent feature of the financial and monetary landscape in the next 3, 4, 5 years. So that's very important, very important. And the second thing which worries me is the increased fragility of the government debt market in the advanced economies. Right? And most of you may not remember and may not be aware of that because hasn't been that much commented outside of the central banking and financial regulator circle. But in March 2020, when first the COVID was declared as a pandemic officially, there was a huge disruption on financial markets, including on the Treasury, US Treasury debt market, which is the broader, most liquid, safest market in the world. And it was so disrupted that the Fed had to intervene. And to my recollection, I didn't have time to check the number, but they spent like between 1.5 and $2 trillion stabilizing the market in the few weeks which followed the March 2020 disruption. So that tells you, and some reports have been, that tells you that even at the very heart, the safest, the most liquid part of the international financial system, you can have shocks and disruption, which nobody expected before this episode occurred. There have been reports which have been written on that episode. They are not all conclusive. So you can see that there are at least 2 causes which have been 2 plus 1, I should say. There's 1 bullet point missing here. 2 causes which have been identified as the source of problem. The first is that on the liquid market, you need market makers. You need people to buy and sell. You need intermediaries to buy and sell when there are temporary imbalances between supply and demand. That's the role of dealer brokers and market makers in general. But these people, who usually are banks, they need to have a balance sheet capacity available. And now with the regulation on Basel III and the so-called leverage ratio, they don't think they have a balance sheet capacity available. So they were very timid and absent in making markets during this period. So that's kind of easy to fix in a way. You could disband them from the leverage ratio. Apparently, it hasn't occurred, although some reports advocate for such a measure. So you can see a tension here between some kind of financial stability objective and other financial stability objective regarding the bank. The second thing is that it has been discovered there was a lot of leverage strategies implemented by some private equity hedge funds. And of course, because the treasury bonds would not yield a high return in a period of very low interest rates, people try to gain yield and return by very highly leveraged strategies. And those strategies, of course, I cannot get into the details, but those strategies amplify market movements where they are unwanted. And that's what happened. So there were a lot of selling pressure from those leveraged investors and nobody to face that selling pressure in front because of balance sheet capacity. And that has led, this is a bullet point which should be missing, should be here and missing, that has led to some proposals of reform of the market. And including on the market central clearing capacities, CCPs, which would reduce the need for liquidity because intuitively you can see that a system of decentralized broker-dealer needs more liquidity than a system when everything is centralized and positions are netting out between interbanks. Personally, I think this is all very useful. You really have to ask yourself, okay, whether something very, very deep has not changed in the perception of markets. And when I talk to market participants, some market participants at the time, they told me what changed is that usually you would assume that a very short-term treasury bond, like a 1-month treasury bond, is equivalent to a deposit or reserve at the central bank. But this episode showed that in the eyes of the investor, they were not equivalent. Okay. So I don't know what to make of that, telling you the truth. But I think central banks have to internalize now that people are very, very worried about. I mean, that those shocks can occur, and that the need for central bank money may appear to be very, very strong in the future. Is there a risk of fiscal dominance? Last point. Don't think so. It's not, to me, a concern at the moment. I think, again, the Bank of England has very, very aptly and smartly managed the situation. There is, of course, and some of you are from the euro area aware of it, a debate on Europe on how far the central bank should support and intervene on the debt of peripheral countries with the risk of fiscal dominance. But there is an increasing strong link between the balance sheet of the central banks and the balance sheet of the government, right? So you see now, this is a graph which shows the public debt. And you see now the share of the public debt which is held by the central banks. And the Federal Reserve only hold like 20-25%. But in the euro area and in the UK, more than 1/3 of the total public debt is held by the central bank, right? And in Japan, of course, it's almost 50%. So this is a totally new configuration. And you could say that the central banks and the governments are sort of joined by the hip, right? Because the government is issuing debt, but most of this debt is now held by a government agency, which is a central bank, and which creates money. So I've tried to show the kind of link that may exist between the two. So the government issuing bond, this is the balance sheet of the government. The government is issuing bond. Part of this bond is held by private sector, but part of this bond are held by the central bank, which in counterpart issue reserves. Right? And those reserves carry interest. Actually, the interest rate reserve is the main policy tool that the central bank are using. Right? So the government is paying interest rate to the central bank on its debt, but the interest rate is sent back to the government as profits. So basically what this does is to transform a government debt, which is issued long-term at fixed interest rates, into a quasi-government debt, bank reserves, which are a liability of the central bank, which is part of the government in a way, on permanent but floating interest rate depending on monetary policy. And this is going to go up. This is going to go up. Interest rates are going up. And of course, that means that the central bank may have an increasing gap between its cost and its income. And you had the title in the Wall Street Journal 3 days ago, a new business from the central bank, losing money, losing money. Right? And that means that monetary policy will be perceived as having a direct fiscal implication. And that's a very dangerous territory to get in from a political perspective. So I don't see, again, in the short run, any kind of problems of fiscal dominance. But the fact that the central banks are holding more than 1/3 of the outstanding government bonds, and the fact that it's transforming a fixed rate into a variable rate according to monetary policy is creating potential pressure in the future. So what are my own sort of thoughts? And again, this is very personal, right? I think first, independence of the central bank is more important than ever. This is the last moment where any sensible government would want to be seen as impinging on the central bank independence. And it may have to be strengthened. it may have to be strengthened, and I think people should think of the way they could signal their respect. I may be a little bit idealistic here in some countries, but they should do that. If that were to be granted, I think the central bank should have a total flexible approach in managing their balance sheet. I think their tendency to wanting to reduce their balance sheet, absolutely, and this nostalgia for a period of small balance sheet and low imprint on financial markets, which goes back to 12 years ago. 12 years ago, the balance sheet of the central bank was 10 billion. Today, 7 trillion. So there is a very sort of different order of magnitude. I think this is wrong. I think they should have an elastic balance sheet. Just like you want to have an elastic supply of money, you want to have an elastic balance sheet, and that should be incorporated into the framework. You should signal to the market that you are prepared to face market disruption without giving up on your price stability objective. And you should have a framework which allows you to do that. There may be elaboration on that. But I think it's dangerous for the credibility in the current period to signal that you're going to contract your balance sheet, which they're all doing. All the big three, all the big four, they are doing that. I think it's a mistake. And I think they are facing the kind of circumstances that the Bank of England has been facing and which I described at the start. That may be very difficult. So this will be my own personal proposal. Have an elastic balance sheet framework for the next 5 or 6 years. And they should totally focus on this already extremely difficult equilibrium of maintaining financial stability and getting to price stability in an environment where fiscal dominance remains a danger. And some of them, including in Europe, are potentially losing that focus because for good reasons, they think they should mix and get involved into some kind of credit allocation, for instance, for helping to finance climate or the climate transition. While I recognize this is a valid objective, I think it would be for the central bank a very, very dangerous move at the moment, because again, they would get into a position where the risk to fiscal dominance and fiscal inference would be much bigger. So for me, these are the 3 principles. They are not waterproof. They cannot guarantee success, but these are the 3 principles which should really guide the central banks in the period to come. And then there are 2 questions, of course. One question which everybody can see coming is who is going to have access to the central bank balance sheet? And are we going to stay in that position when only a restricted number of intermediaries have access to central bank balance sheet? Or does the change in financial intermediation and the technological evolution will force increased access to central bank balance sheet? And second, this is my own sort of personal question. When you have a 3 or 4 trillion of reserves, and when you go interest rates up to 4 or 5%, the temptation to have some kind of reserve which are not remunerated may become, and actually it's a legitimate concern and prospect, and you might have some kind of quote unquote financial repression on the banks to preserve the integrity of monetary. I'm finished, and thank you for your patience, and thank you for the time.
We certainly do have time for questions. And I will ask that you speak into the microphone when you ask your question. Just raise your hand. We'll start over here and work our way across.
Thank you. Thank you so much for a great presentation. I'm wondering about when you talk about the central bank purchase pound or sell pound, or the tightening monetary policy or quantitative monetary policy that impact the money supply in the market. How that also impact on the fluctuation or elasticity of the interest rate and the exchange rate. Thank you.
No, maybe I'll take a few questions.
Thank you, Jean-Pierre. I'm curious to know if the change in financial intermediation that you spoke about is also a European phenomenon, or is it only happening in the US?
So you mentioned earlier that you don't think that the current strategy by central banks is going to have the risk of a large negative shock to the economy. I'm curious about what central bank actions you think would increase the risk of a deep recession.
Okay. Shall I?
Why don't you go ahead and answer
Yeah,
those, and
yeah,
then we'll get
yeah.
another group.
Yeah. Yeah. So the question, I mean, this remains a fanatic question whether the quantity of money has an impact on inflation and monetary policy. So the standard answer is no. No, we can both have a huge amount of money, and if interest rates are the current the proper level, you can control inflation. And this standard answer is broadly true. So it tells you that the demand of money is very, very unstable, that people at some stage may want to more money, you give them more money, less money, you give them less money, and this is independent of monetary policy. That's the standard answer, and I would say it's 80% true. But in my mind, there's still a 20% question about that. There's still a 20% question about that, and you may want to read a recent speech by Mr. Jean-Pierre, who is the chief economist of the Bank of England. I'm referring a lot to the Bank of England today, who sort of took stock of all the thinking about the relationship between money, inflation, and financial stability. And it's not very clear, you know, that if you have an enormous amount of money, and if that money starts to move around, if the velocity increases, that you can control the process when increasing interest rates. It's not absolutely clear, neither theoretically nor empirically. That's one reason why you don't want inflation expectation to slip, okay? Because, I mean, the basic model of money demand that you have in your mind is that it depends on inflation expectation, part of it, and uncertainty, right? So at the moment, money demand is relatively large because there's a huge uncertainty of the economy, and long-term expectations are not totally unanchored. So even if I sort of internalize the fact that money may have an impact to the economy through changes in velocity, that's for me another reason to be very, very strict today. Financial intermediation in the euro area, well, it's less debt. Of course, the banks are much more important in the euro area than they are in the US. But we all have saving accounts, pension funds, life insurances, and all these products are invested into ultimately some kind of open funds in different forms. And so a systemic shock on funds, I don't think it would leave the European area, the euro area, or the European Union unscathed. And you may remember, you're too young to remember, but in 2007, the whole thing started because one fund, French bank, BNP Paribas, suspended redemption. Two funds, sorry, two funds. So that is my personal nightmare, you know, that funds protect themselves. They have the tools to protect themselves, but they don't have the tools to protect themselves without inflicting externalities to others. And I don't know how the system would react to that. So if that happens, I hope it won't. But if that happens, then the euro area would certainly not be. What could create big damages if money? What could create big damages is a huge rise in financial instability. So what could really create big damages in the short run is some kind of financial crisis with financials, assets falling, right? Long-term premia increasing, and then you don't know what to do. So again, I think if you assume some kind of financial stability in the next 12 months, I'm reasonably confident that inflation can be brought about control with as little real damage as possible. If that process of tightening, that's why financial stability is so important in the current picture. If that process of tightening triggers some kind of big financial shock, which I would not exclude, either in the advanced economy or the emerging economies. I haven't talked about the emerging economies at all today. Too much talked about on the advanced economies. then of course the shock can be bigger.
Thank you very much, Jean-Pierre. Brilliant talk. I would have two questions. The first has to do with your analysis of financial instability. I would add to your 3 points you highlighted there, the issue of high frequency trading, which creates a massive illiquidity. Markets are terribly narrow, no depth, and hence volatility goes up like mad, even in the treasury market. And that led the Bank of England and our friend Hugh Pill to eat his words after 2 days. So isn't there also an issue of microstructure of markets, which can just blow up the whole thing, and you in your nice triangle, you're done. There's no trade-off and no dominance. It's done. You accept the implosion. Second point, I would really like to have your view on that. The second point has to do with the transmission protection instrument in Europe, which means that the central bank is supposed to assess whether spreads in government bond markets are justifiable or not, leading immediately to you being involved in the political economics of whatever country, which could be very nasty. And it's closely related to a job central bankers hated to have, never had. Wim Beuter came up first with that market maker of last resort. Central bankers even hated to be a lender of last resort, constructive ambiguity. So how, easy questions.
I'm not surprised coming from you, but.
No, I'm from Turkey, so like we are taking pride in basically saying that our central bank is not independent anymore. So we got rid of the political rate out of the question. But my question is not about that. I want to ask you about the spillovers between countries, like demand spillovers and other things. So like given that we have globalization, we have financial globalization and so forth, how like do the central banks need to coordinate among themselves more in terms of their rate hikes and tightening policies and other things?
Shall I? Another one. Yes. Yes.
Yeah.
Yes.
What's your take on the TPI? So is that an instrument that the euro area really needs?
Okay. So I will join that question with the second question of Hans Helmut, because he was on the TPI. First, on the high frequency trading, I think you're absolutely correct. You're absolutely correct. And it's very hard for me to understand the social benefit of trading in nanoseconds rather than milliseconds. Right? And I think regulators should really look at that. I think we have, on the long run, a much more basic question to ask ourselves. We have a lot, and that refers to our discussion yesterday. We have a lot of monetary and financial processes which are going to be automated. And automation means algorithms interacting with each other. And you must have read, like me, all the reports on the flash crashes which occurred on the most liquid market in the world, and that relates to your question. And these are very heavy reports, 120 pages. And my own personal, maybe a little bit simplistic conclusion is that we don't understand at the end of the report. And the truth is that increasingly, we're going to be faced with the interaction between algorithms driving very important processes for the moment in finance and money, which we don't understand. And I think that's a big question. And I think on market activities, it should be looked at very, very clearly. Now, on the TPI, there is a rationale on the TPI. There is a rationale on the TPI because past a certain degree of destabilization of that market, the monetary policy doesn't work. That's why it's called transmission policy instrument. The transmission policy is broken. And I think that's a case which is unassailable. Now, you're absolutely correct. And the question is, so you're absolutely correct that the risk is that, the central bank is a judge on solvency premium, which it doesn't have to be. And so if it starts assessing good solvency premiums for Italy, for Spain, for whatever, then they are outside of their rule. And that's a danger. That's why we have colleagues, economists, who start elaborating models. What's the right premium for Italy? We shouldn't do that. This is clearly a question where ambiguity or constructive ambiguity is predominant. They shouldn't say what they're going to do. And I think you can recognize a liquidity crisis when you see it, just like an elephant. You don't have to define it ex ante. And actually, if you don't define it ex ante, you minimize the chance that it will happen. I mean, again, I'm old enough to have seen the crisis created by target exchange rate, target zone, and so on. You don't want to target a financial price explicitly at all. You want to have your firepower. Your firepower should be undetermined in amount. And you should be able to use it in conditions that market participants cannot guess. That would be my philosophy on the TPI. And I think this is the only one. And of course, you are accountable. If the Parliament, if the European Court of Justice, which already had its say many times on the question of the bond purchases by the central bank, finds you outside of mandate, that is their job. But I think this is my answer to you. There is a risk. The risk can be managed for accountability, good accountability, and certainly not by defining ex ante a framework for intervention. That would be a total recipe for failure. Your question on market maker of last resort, they don't want to do it, and they should not have to do it. The market making should be the business of financial institution with a strong balance sheet and a strong capital. But those financial institutions have now been impeded in doing that job. So one of the taboo, one of the corpses in the cupboard that we have is that the central bank somehow do not feel that they can confront the regulators and say, listen, there are some regulatory measures on the leverage ratio which are plain stupid. And putting some kind of repo operation or the reserve euro of the central bank inside the leverage ratio is not conducive to our own global public policy objectives. And there's a trade-off there. The more you constrain the private intermediary into market making, the more you have to do it by yourself as a public entity. For me, it's kind of overly simple, but this is basically the trade-off that you are facing. I'm not sure that if the private entities were allowed to do some more market making, it would totally eliminate the role of the central bank. But I'm pretty confident it would reduce it massively. So part of the reason why the central banks are increasingly taking on a role that, you're right, they don't like, which is the market making of last resort, is that the private intermediaries who were in charge of doing that have been prevented to do it by regulation. And then the question of spillovers. Well, I haven't talked a lot about it. There is the conventional wisdom that central banks should not coordinate monetary policy because, and it's unrealistic to think that they will coordinate monetary policy because they have a mandate, and any Fed official will repeat that ad nauseum. They have a mandate for domestic accountability. They don't have a mandate for international accountability. What is very interesting in my view, and I was surprised to see that in the last 9 months, is how the emerging economies have managed the current situation. And actually pretty well, pretty well. There has not been market disruption. There has not been recession. There has not been huge depreciation in exchange rate. If exchange rate problems have arisen, it's between advanced economies, the yen versus the rest of us. So up to now, I think the expertise that big emerging economies have acquired, big, medium-sized emerging economies have acquired in managing that kind of situation has been extremely helpful. I've read somewhere, I don't have access to much information, I've read somewhere that they spend almost $1 trillion in reserves in managing the situation. So it seems to me that between the free instruments that they have to managing capital shocks, which is the exchange rate, the reserves, and interest rates, they have done very well, and equilibrium, and they equilibrate their action according to those instruments. They have drawn on their reserves. Some of them have accepted depreciation, but not to the point that it would create unsustainable inflation pressure in their economies. And some of them have raised interest rates. So up to now, they've done pretty well. Up to now, cross finger, up to now. But up to now, the kind of shock that the previous experiences of 2013, 2014 would have led us to expect for emerging economies has not occurred. Again, it may not last. Nobody knows. And the last point of coordination, of course, is about liquidity provision. This is the very political question of swaps. Whether the Fed and the ECB and other big central banks will, the moment come, grant some swaps to emerging economies to help them to face external shock. That, of course, is a permanent, constant aspiration of big emerging economies. It's a permanent, constant political constraints on the Fed. It's going to be very interesting to see how it plays out.
Yeah, just one question on the view that you characterize as completely misguided. I think I also would see it as misguided, but not. I think they have a point in one thing, and I think there's like a burden of proof a little bit on your side, and I want to ask about that. It feels that the argument of that side is to say like we can fix the supply side through the demand side, so let's not worry about it. And then the counter argument is to say, well, there's this huge danger that it at some point will unanchor inflation expectations and it will move from shock to process. And I see that danger, and I see that point where I have some sympathies for that other side, is that this is this odd black box that is sort of empirically not fully well-founded of this thing that we can't observe, that is inflation expectations, and that we don't really have good signals for in the market of what they are. And I think you said at one point, well, it's a matter of risk management because the costs are really high, but now we have to manage the risks of that happening. But what I would a little bit want to know is like, what does that risk management actually look like? What data are you looking at when you want to proxy inflation expectations? How does that process actually unfold? And I think to just point at there's this thing of expectation that's really dangerous, I see a point of that misguided view. And I wondered whether you have some thoughts on how do you measure that? How do you actually assess these expectations in a way that they guide your decisions, which are really, really meaningful?
Okay, so there are two, I think there are two questions. What is exactly the state of expectations? And we could have a long debate on that. But I showed you some kind of, inflation swap 5 years over 5 years. Now, if you ask the person whose food bill or energy bill has doubled over the last 3 months, the question of whether the 5 years in 5 year inflation swap is stable or not will sound a little bit academic. So a lot of people will tell you, of course, these are stabilized, the market expects stability. But most of the people whose behavior matters because they are wage earners, they are consumers, those one, their inflation expectations have been jumping up very much. It's, of course, it's short term. So it's not as sort of reassuring as it might be. And then first point. Second point, you have wage behavior, which now, I mean, there's a big difference between 6 months ago. 6 months ago, wage were relatively stable. And at the time, I was more dovish than I am now. Now you see the nominal wages going up everywhere. And third, in most of our economies, we are still very close to full employment, if not overheating. So the real damage of tightening, starting from that position, is not, in terms of global social welfare, is not that big, okay? It's not like if we were starting for 7, 8, 9% unemployment. We are starting to very close to full employment. So now getting back to your second question, the risk management, is it worth risking 1 or 2% unemployment, starting for full unemployment to stabilize inflation expectation. Or if we don't do it, we have 8%. If we have this 8% getting ingrained into expectation, then we know from the Volcker experience. I mean, it's very old. That's the problem. People don't remember it. But we know from the Volcker experience that to beat that, you have to get a recession of 2, 3, 4% 2 years in a row. And that is going to create a 15% unemployment rate. So in terms of risk management, again, I'm sorry to be so simplistic and so schematic. The question is whether you get 1, 2% unemployment now. Nobody is going to frame it that way, of course, or 15% in the future. And I think that is the answer. And again, I mean, my own sort of intuitive view on expectation. Central banks have been very lucky because after 30 years, people who know what inflation is in the current population, very minority. Most of the people who are active never knew what 3 or 4 or 5% inflation was. Never knew. So you can assume there has been some kind of inertia in expectations. But now, the more you wait, the more this inertia dissipates. And this is an asset that you have spent. I think the case for acting is very strong. The only question, of course, is to try to figure out the scenario if you don't do anything. And some scenarios, if you don't do anything, would project that activity will slow down or even fall over a 6 and 9 months period. And then you might not want to over-amplify that more than necessary. This is the lag versus expectation that Blanchard, I think, in a very illuminating way described.
So I'm going to exercise my prerogative of holding the microphone. So there's an interesting article in the Wall Street Journal this morning, and it's about the relationship of fiscal policy to monetary policy. And one of your personal thoughts up there are strengthened independence and total flexibility. And I'm trying to figure out what the implications are, what you mean by that in the context of the relationship of monetary policy to fiscal policy. And it comes up particularly in the context of, if you think about the massive budget deficits that are occurring, and then you think about the monetary policy, and you just look at what happened in Britain when, Liz Truss announced the tax, and then all of a sudden all hell breaks loose, and then the tax goes away, and the monetary policy, discipline, fiscal policy, and there's this whole Johnny Cochran, fiscal theory of price levels and the relationship between the two. So I'm trying to reconcile the independence notion with the integration into fiscal policy and thinking about how those should be integrated.
So the FTPL is a fascinating topic. I'm not sure I can develop it now. I could develop it, but I think my very simplistic way of putting it is that if you are perceived as yielding to fiscal pressure, then the whole inflation expectations are disanchored. Then in 5 years that we show that 2% is going to go to 3 and 4. And if it goes to 3 and 4, everything will slip. So you don't want to be perceived as yielding, and you can put that under different theory, the fiscal theory of price level, the unpleasant monetary arithmetic, but you don't want to be perceived as yielding to fiscal pressure. That's the red line that no central bank want to be seen. And that's the red line that the Central Bank of England get very close to crossing, and to great pain not to be seen as crossing. And I think for me, I don't see that as a major threat now. But when you have parliamentarians in all countries which will see that the central bank is paying $10–20 billion interest to the banks, something's going to happen. And I hope it's not going to trigger challenge to the independence of the central bank. But let's say if it's fully independent, then I think it can expand or contract its balance sheet without people thinking it's doing something unsavvy, right? So it's mainly a major matter of perception. Now you have big fiscal elaboration. So John Cochrane will explain to you that it doesn't matter. It is the fiscal stance which matter. But then the same people explain to you that fiscal deficit have not triggered inflation because people expected that they would be corrected in the future. So we are in a game of between fiscal expectation and monetary expectation. And this is why, this is how the two interact, which matters, right? So the FTPL is perfectly consistent with what we see now. If people think that any slippages in public finance will be corrected in the future, then the FTPL doesn't tell you that we necessarily need to have inflation right now. It's all about whether you expect that the right policy will be conducted or not. I'm sorry to refer so much about expectation, but it's very, very important at the current juncture.
Terrific. We've hit the witching hour. It's a little after 1 o'clock. I want to thank everybody for coming, but in particular, I want to thank Jean-Pierre for another terrific.